Good morning. This is George Ristau, your host for Hour 91, our podcast on important matters affecting the real estate marketplace. Our guest today is Ron Ricchio from Chicagoland Home Mortgage Services. Ron's been a frequent individual that's been with us on our podcast, and we do appreciate him coming in here on Victory Monday for the Bears, December the 10th, for those following us. And Ron, I know you mentioned you saw part of the ball game last night. So what were your thoughts on the Bears before we get started on the mortgage business?
Well, I think the defense definitely carried them. Trubisky, unfortunately, didn't have such a great game with the 3 interceptions, but I think they're looking very promising, giving the Rams their second loss of the year, which I thought was great. So I think it gives them some momentum going in to the playoffs here. So I really liked that. Really liked what I saw.
Sure. That's good. Obviously, we've had some lean years here the last 5, 6, 7 years with the Bears. I was in attendance when the Bears lost the game to the Packers, which was the one they lost late, and it cost them effectively an opportunity for playoffs several years ago. And it's great to see them back on the rebound. It's also a good thing for the Chicago population in general. I think it makes everyone a little bit happier, and it also makes our winter season go a little bit more quickly too. So
Absolutely.
that's
Absolutely.
definitely. Excuse me. So, Ron, we're here today. We're going to be discussing some new trends in the real estate business, providing some good information for our listeners. And one of the things that I noticed this morning, and maybe we'll talk just in general before we get into some specifics, is the name Diane Swank. Are you familiar with Diane?
I am not.
Okay, Diane is an economist, and I had an opportunity to see her. I believe she was the lead economist in the day for Chicago National Bank, or one of the large banks downtown. And she's a renowned economist who had an MBA from the University of Chicago. She's quoted in today's Tribune in the business section. And Diane is well thought of. And her thoughts on interest rates, which are always a factor that we look at, is that she's looking at the possibility of 3 or 4 interest rate changes in the upcoming year with quarter point changes. And we've always talked about that, and the interest rates are, of course, a factor in the marketplace. But since I have my own economist sitting right across the table from me, with the ability to not only take a look at past performance in the marketplace, keeping in mind that no one knows what tomorrow will bring. How do you feel about interest rates as they stand right now?
So based upon what we're seeing right now, we feel that the Fed is potentially going to raise here again in December. And then going into 2019, they had initially said that they were looking at potentially maybe 2 to 3 rate hikes in 2019. They've really taken a step back now and said this is going to be data dependent. They're going to be looking to see what inflation looks like, what unemployment looks like moving forward. I think the big concern, too, is the possible tariffs if we get into this trade war with China and it pushes up the cost of some of our goods. It could potentially pull back on the economy. So that's why we're seeing such volatility in the equity markets here the past few days. I mean, I think the stock market was down 400 or 500 on Friday, somewhere around 500 points on Friday. And the Dow futures were pointing to a negative open this morning. So I think that the Fed is going to move forward potentially with a rate hike here coming up next week next week for the December meeting that they're going to have. There was a 76% chance last week that in the futures market that the Fed was going to raise. And then I believe after that, it's basically going to be a wait and see. So there could be another couple of hikes. It's really, really closely tied to wage inflation. So if wage inflation can stay contained, I don't think the Fed's going to be in such a hurry to move up. Overall inflation has been around that 2% benchmark where the Fed likes to see it. So right now, if the Fed can kind of walk this fine line, we may be in a situation where potentially mortgage rates will stay below 5%. and the Fed may be getting to a more of a neutral policy, so which would be good, and moving forward would be a very good scenario, I think, for the real estate market.
I think we saw rates hovering in the 5% range just a few weeks ago, and then noted that they did come down a little bit last week. And typical quotes in the marketplace, and for your firm at that time were about 4.75, which is a significant change, at least in direction, for rates, because we have seen kind of a steady influx with them going up this year. So that's, I guess, good for real estate buyers. They can get in the marketplace, lock up 30-year fixed rate mortgages long term, and be in a position that they have that long-term stability in their mortgage payment, which is a substantial component in your household budget. So the focus for us, with our industry, is that we have to keep an eye. We kind of have split personality scenario that we're watching the daily interest rates, but we're also continuing to represent sellers of homes through all market conditions, and also represent buyers on their needs in the marketplace. So ultimately, doing that at the same time, you're again never very sure what's happening. Traditionally, the months of January and February, at least in my experience, seem to usually be a little bit slower months on the real estate side, and then usually interest rates are not typically going up as appreciably during that period of time. Usually a little more in the springtime. Does that seem to follow the patterns, or not so much?
Well, it really depends, I guess, on the year. Last year, we actually saw rates begin to rise in January and February because of the tax cut that was put into place. So we saw rates beginning to move up, but that was long overdue. I think they were waiting for that. But typically, if we see a little bit of a pullback in activity in the real estate market, we may see some pullback in terms of rates during that time. But again, it's really mostly data dependent upon where inflation's at. Of course, GDP and wage inflation is the big key. I think that's the big key here at what they look for.
Yeah. To get back to a football reference, I'm glad that the Fed is taking that position, because to have a game plan in place for plays that may or may not develop in the future is somewhat problematic. So I think you have to be prepared to adjust the game plan. So if you think that the tendencies are moving more in that direction, that seems like a more sound approach than having a predetermined interest rate plan that does not reflect what's going on really in the economy on a day-to-day basis.
I think the worry is if the Fed does too much and begins to slow the economy down. I think that's the concern, that they don't want to tip it the other way. Things have been going well. Unemployment's down. It's below 4%. It's been between 3.7 and 3.8. And job creation's been pretty good, although this past month it came in at about 155,000. They were expecting about 190,000 new jobs for the month of November, which was still pretty good. There were some slight revisions to the previous months, but overall, unemployment's down. The economy continues to grow, and they're just concerned. They want to make sure that the Fed, and even the Fed itself, wants to make sure that they're not going to overdo it and just get to a more of a neutral stance at this point.
Yeah. So if I was representing a buyer in today's marketplace, which I am currently, no real hesitation to go out and buy right now, where you could potentially get a good seasonal price on a property based on availability in the marketplace, and still, as we mentioned before, have a favorable interest rate compared to what it might be down the road.
Absolutely. I mean, I think right now the market, we've seen a little bit of a pullback here in rates, which I think is very good. And I think being that existing home sales on a national level have trended down the past 5 months, I think it's a great time for buyers to be in the market right now. There's not as much competition right now in terms of other buyers. So I think it's a great time to buy. And I think moving forward too, going into the spring, if rates can stay around these levels, I think it's going to be definitely a great spring market for people that are looking to buy here in the beginning of 2019.
Great. That's good news. And so, that being said, let's take a look at some programs that might be out there that would be beneficial for individuals that are kind of sitting on the fence right now. They have some cash available, but not too much cash. They may have family access potentially to some money that could be used to acquire a property. And there are programs that are out there that permit individuals to get involved in that scenario. So give us a little bit of an idea as to some programs that might work. I know you sit down and you do counseling with buyers, so you're on the front line also, and you're giving them recommendations on a regular basis as to programs that'll be potentially favorable to them when the time is right.
Yeah, the one that I wanted to talk about today is the FHA program, Federal Housing Authority, FHA, which comes with a very, very low down payment. It comes with a 3.5% down payment. So basically, for every $100,000, the buyer's coming up with about $3,500 for a down payment. The benefit to this is that they have not only a low down payment, but FHA also allows for lower FICO scores. So your credit doesn't have to be perfect in order for you to use this product, in order for you to gain entry into the real estate market. You can be as low as a mid FICO score of 580. So when we pull a credit report, we get all three bureaus. We get TransUnion, Equifax, and Experian. If your middle score is 580 or higher, you're eligible to apply for this FHA mortgage at that 3.5% down. FHA also goes down to a 550 FICO score with 10% down. But typically, most people are using this FHA program using the minimum down of 3.5%, which is great. It's a great entry point. It's a great product for people to use as a first-time homebuyer program if they don't have excellent credit. It can be used for all types of properties. So it can be used for single family, it can be used for townhomes, it can be used for condos, and it can be used for multi-units. It can be used for 2 to 4 unit properties. The key here is that typically all single family homes are eligible for this product, and townhouses are also. Condos have to be an FHA approved condo project. If it's not an FHA approved condo project, you cannot use an FHA loan in order to purchase that property. You can also do minimum down 3.5% to buy a 2 to 4 unit. So 2 to 4 unit, this is really great for somebody who wants to get in to real estate, wants to buy something, live in it owner occupied, and potentially have this other rental income for somebody to be able to use to help pay their mortgage. You can use it on a 2 to 4 unit, and it is still a minimum of 3.5% down. If you have a 3 to 4 unit that you're purchasing, there's a special rent self-sufficiency test that has to be done. So they'll look at all 4 rents or all 3 rents of the property, and they'll take 75% of that number. And if that number is lower than your mortgage payment, then FHA will not do it. FHA will at that point say that this property is not self-sufficient in terms of being able to carry the mortgage on its own in the event that a borrower decided to leave. So on a 2 unit, there is no self-sufficiency test. And so as long as the borrower qualifies, that's fine. We also use 75% of the other rents in order for somebody to help qualify for the mortgage. So we'll take 75% of the other rents that are in the marketplace that are there for that property, and that's determined by the appraiser when the appraiser goes out to do the appraisal, how much the rent is, and they'll take a market rent for what's available in the general area. So it's a great product. It's really a great product for us to be able to use and for people to use as a good entry point. A couple of things to keep in mind with FHA that's different from a conventional loan is that the appraisal is typically a little bit tougher than a conventional loan. So if you're buying a property using an FHA program, an appraiser goes out and will look to see if there's any peeling paint on the interior or exterior of the property. So if the property was built prior to 1979, when lead-based paints were typically the only thing that was available, appraisers will want you to scrape and paint any peeling paint that's on the interior or exterior of the property. Now, why is that? Years ago, there was a time when children actually ate some of the peeling paint, and some of them got sick, some of them actually died, and they sued FHA, and FHA lost because of the fact that they said that you should have protected us from this. So this is why this happens now. I get a lot of people ask, well, why? What's the big deal with peeling paint? Well, this is the reason why. So FHA had this problem before with lead-based paint. So if there's anything here in regards to any peeling paint, it has to be scraped and painted prior to closing.
And that eliminates the risk at that point if it's been scraped and painted?
That's correct.
For the most part?
It'll eliminate the risk where there's no peeling paint that no children can get at and actually eat, and that's what was happening. So that eliminates that risk. They also look at GFI outlets. So the GFI outlets are typically the ones that are in the kitchens and bathrooms, and FHA wants those. So if it's an older home where they have regular outlets in the kitchens and bathrooms, they want these special GFI outlets where if water hits them, they automatically will trip and shut off as a safety issue. Those will have to be replaced if, in fact, those are not in place when the appraiser goes in. And then lastly, they look at wanting to have every level of the home that someone's buying is having a smoke detector and a carbon monoxide detector. So those are the three big things with FHA in terms of an appraisal. With conventional loans, that's not something that's needed as much. They do look at certain safety issues, but FHA is very, very big on making sure that the property is in safe condition when a borrower actually closes on it.
So from the perspective of multiple marketplaces which we work in, we're very familiar with most of the municipalities that are close to our office, and almost all of them have similar safety requirements that would be required by FHA, and that most notably, say, the villages of Elmwood Park and certainly River Grove, Norridge, Harwood Heights, and Franklin Park, many other communities, Berwyn, Cicero, as we go a little bit to the south. Most of them are going to require that via a village inspection if, in fact, that municipality has that. So you're oftentimes covered. Where sometimes we run into issues is the city of Chicago because they do not have a required municipal inspection, and that's probably a double-edged sword. It's nice to have the inspection, but unwieldy sometimes in making sure that the work gets done and also that it gets re-inspected. So the buyer now is a little bit more on their own. Oftentimes there now, yeah, as you've mentioned, FHA does provide a safety position for those buyers in Chicago. Now, if you're a conventional buyer, for example, in Chicago, typically that would not be a part of the program. So then you'd have to rely on your own individual inspector to raise those things, and you'd be on your own.
That's correct.
Ultimately, to complete them. Have you seen any conventional lenders that have required any of these safety items, or for the most part not?
So typically on a conventional loan, it would have to be something that's more blatant. It would have to be something to the effect where maybe some wires were sticking out of a wall, or maybe there was some obvious water damage for an appraiser really to comment to say, hey, we need to have this inspected by a professional and we need to have this remedied prior to closing. Typically, if there's peeling paint or if there's not GFI outlets, they typically don't say anything and they don't want those changed. They like to see the smoke detectors and carbon monoxide detectors on a conventional loan. But typically, the peeling paint is not an issue, nor are the GFI outlets.
Okay, that's good news. It's always good to have, of course, a good real estate agent to represent you if you're the buyer of a property, and as part of that process, of course, going hand in hand with the closing process is to make sure you have a professional inspector take a look at the property and make sure you have a good attorney that's going to represent you, also to potentially negotiate items that may have been somewhat of a surprise along the way that you were not anticipating as part of that inspection process. And certainly those are avenues that we explore and we discuss with our buyers as we're preparing offers on their behalf.
And typically when an issue like this comes up on an appraisal, where there is peeling paint or there is a GFI outlet that needs to be taken care of, that's typically done by the seller, and then the appraiser has to go back out They do a reinspection. They take some photos to show that it was completed, and then that's submitted to the lender, and then we are on to closing at that point.
Okay. Does this seem to have an extended time frame in order to accomplish this, or can it be accomplished in the normal closing time frame?
No, it's
Everybody's
usually
on their game.
yeah, it's usually accomplished in a normal time frame. Of course, it's dependent upon how quickly the seller and the listing agent coordinate to have those repairs completed. But typically, once they're done, we send out the appraiser. Usually within 48 hours after we've been notified, the appraiser goes back out, does his reinspection, shoots those photos, and then we get those uploaded to the lender and we get set for closing.
Good, good. Well, I know that in our representation of sellers, oftentimes we will try to prepare our seller to receive an offer that could be an FHA offer. Why do we do that? One of the reasons is that we want to increase the marketplace to have more potential buyers eligible to purchase their home, which in turn means potentially more offers, higher prices, from the perspective of the seller on that representation. But they need to do something also along the way. There are many myths about FHA going back to the realities of when the programs first started in the 60s and the 70s, and there were many horror stories there of FHA lists that were 30 or 40 or 50 items that needed to be completed in those days. So it's good to hear, and we need to re-educate some of the sellers that lived through that era that it's a different story today with FHA, again, focusing oftentimes just on most of the major items and then some of the safety items that you just identified there.
Yeah, that's correct. It's much more streamlined now, not as invasive, I guess, as it was years ago in terms of the repair list that they had.
Right. So FHA, as we just discussed and you eloquently summarized, gives that buyer this opportunity to come in with 3.5% down. Now, what if they're a little bit short on cash? They have some money available. They may have the money for the down payment. They may not have any extra money. So are there some other things that they can do to make sure that they're going to be able to put themselves in the best position to be able to get a home?
So you touched on a point about the down payment. So the down payment doesn't even have to be there. So if a buyer has zero money and is gifted the down payment, they can be gifted all of that money. They can be gifted the down payment. They could be gifted the closing cost, or they can be gifted the down payment, and then we can get the closing cost paid for by the seller. So there's a number of different ways that these buyers can get in with very, very little money, 3.5% down into a property. So if you have a seller, like I said before, that wants to give a credit for closing costs, we can get up to 6% from a seller to pay for closing costs. So if a buyer is buying something for $200,000, 3.5% of that is going to be $7,000. That's all they would need to show. They would need to show that they have that. If the seller's paying the closing cost, we're off to closing. Subsequently, we can also look to do a credit from the lender. So the lender will also give a credit to the buyer to help pay closing costs if the buyer ends up taking a higher interest rate. So if the market rate today is 4.5% without a credit, and the buyer decides to take a 5% interest rate, the lender, because they're going to be receiving a higher rate of interest, will give the buyer a credit at closing to help pay some or all of the closing costs. So there's a lot of different good ways to get into this property, or where people have little or no money in order for them to come up with down payment.
Well, one of the things we always heard when we were growing up is there is no free lunch. Now, I guess these days there are free lunch programs that are out there. But one of the things with the FHA program that are out there is that a lot of the reasons to go into that program is credit score driven, correct?
That's correct.
All right. And so if an individual now goes into that program, there are some costs that are involved with that program. So let's talk about just very briefly one of the costs that's there, and then maybe an alternative if someone said, well, I really like the idea of the low down payment, but is there some way I might be able to keep my monthly mortgage payment a little bit more reasonable? So what would be your solution on that, Ron?
So, I mean, some of the costs that you have to look at with FHA is that different from a conventional loan is that both have PMI, which is called private mortgage insurance. If you have less than 20% down, you're going to pay what's called PMI. With the FHA product, you pay PMI regardless of your down payment. And then there's also an upfront PMI charged of 1.75%. So for every 100,000 that you're going to be borrowing, FHA charges the buyer $1,750 in an upfront FHA closing fee, which they can wrap into the loan. This is something that they will allow for you to finance into your loan. That's the only financeable closing cost that FHA allows. So typically with FHA, if you have a down payment that's less than 10% down, the PMI will stay with the loan for the entirety of the loan. It will stay until it's either paid off or until you refinance it. So we typically will use an FHA product as a stepping stone for buyers. They'll use it if their credit scores are low in order to get into an FHA or get into a property. And then once we work with buyers to get their credit scores up, we look to go back potentially maybe 6 to 12 months down the road, reevaluate their credit. If their scores have gone up, we'd like to flip them out of the FHA loan into a conventional loan, because even if you have PMI with a conventional loan, once you reach 20 to 22% equity, that PMI will then come off. So with FHA, it won't unless you either pay it off or you refinance. With a conventional loan, the PMI will definitely come off here at some point in the future.
And so I'm sure you're combing through the files for individuals that you made loans to in 2010, 11, and 12, and 13 when the market was down. And now we've seen quite a bit of market appreciation over the last 5 years. So many of those individuals have created instant equity for themselves and are now in a position to come back in as conventional borrowers.
They have. I mean, and we've had people that have really taken advantage of this product. They've gotten their credit up, and then in as little as 6 to 12 months have been able to refinance and get out of that FHA product and get into a lower PMI monthly amount, which has helped reduce even their mortgage payment. So knowing that they've got this PMI that's going to be removed in the future has been a great motivator for them to be able to get their credit scores up to get out of this FHA loan.
That's good. That's good, because one of the key things I think is looking at the long-term benefits of all of these programs. There's more twists and turns in them than may always appear at first glance, and that's why consultants such as yourself working on the borrower's behalf puts that borrower in the best light, the best opportunity to make a good financial decision for the long term for them and their family.
Now, one thing I wanted to mention, George, and talking also about FHA, is that they also have a separate program called a 203K loan, which is a renovation loan. So you can use FHA in order to acquire the property and also be able to add some money to that loan to do renovations. So let's say you're buying a property and it's $200,000, and then they want to do $50,000 in renovations. So instead of coming up with 3.5% on 200,000, they're coming up with 3.5% on 250,000. So it's a great program. And it's done in various ways. There's a limited 203K, and then there's a full 203K. The limited 203K is if you're only going to be using about $35,000 in renovations. That typically requires less work, less inspections, and can close a lot faster. If you go above $35,000 in renovations, that requires what's called a full HUD consultant report, and requires a bit more time in terms of someone being allowed to close. But it's a great program for somebody who wants to buy a dated property and then turn around and be able to potentially do a new kitchen or a new bathroom. And especially today with all these home improvement programs that you see on television where they're rehabbing the whole house in 30 minutes and we're knocking down walls. It's been very popular, and we've gotten a lot of inquiries on this 203K program for FHA. And it's great. It's great for somebody to be able to have limited money and be able to have the ability to go in and be able to do some updates to the property and really put their own personal touches on it.
Yeah, I think it's you could kind of call it your own do it yourself flip, because ultimately instead of buying the flipped property, which has the renovators improvements in and the renovators profit in, then you're in a position where you can negotiate the price, and hopefully if you have that hands-on ability yourself, you might be in a position where you could save some money. However, I know that the program does have some limitations on it, so it's not always where you can get Uncle Joe to show up and start to do some of the renovation work for you. Could you kind of expound upon that a little bit, Ron?
Sure,
Too?
sure, absolutely. So typically in a brief nutshell as to how the program works is if you buy a property, let's say you buy it for $200,000, the first thing that you want to do is we want to send out what's called a HUD consultant out there. The HUD consultant is someone who's going to go out and estimate all the renovation that the property needs. So he's going to have his needs list. The borrower is going to have his wants list. They're going to try as best to incorporate all of that as possible. So let's say it is $50,000 in the example I gave before. So they're buying it for $200,000, $50,000 in renovation cost. The HUD consultant's going to do a report, which is going to specify all the costs and the work that's going to be done. We then take that report, give it to the appraiser. So the appraiser then is going to appraise it based on the future value of the property. So as long as it appraises out for that $250,000 or more, the borrower can be approved for the loan. They're going to come up with 3.5% of the total acquisition and renovation costs, which in this scenario, in this case, would be $250,000. And then after closing, the draws would be paid out once the work is done. Now, you made mention about Uncle Joe working on the property. Unfortunately, it has to be a licensed contractor in the state of Illinois. So it used to be that you had to pick from a list of contractors that was on the FHA approved list. Now they did away with that. You can use whoever you want, but it has to be somebody who's licensed and bonded in the state of Illinois. And they have to accept the bid that the HUD consultant gave them as to what the renovations are going to cost.
Okay, and that bid could be negotiated at a lower amount, or it's got to be the exact face value of whatever the bid was?
So the contractor has to accept that they're going to do the work for what the HUD consultant said it was going to be, either that or lower. It cannot be higher. It cannot. So a contractor cannot come in and say, "I'll do your work, but it's going to be $5,000 over what the consultant said it was going to be." And that, again, FHA is protecting the buyer to say, hey, we want to make sure that the buyer is not going to run out of money. This is going to be done for this price, and if you accept it, this is what we're going to pay out.
Okay, so we're asking that appraiser then to put on the future vision goggles and see the home now that may have the cabinets, original birch cabinets from the 1950s and the plastic tile in the bathroom. And we're asking that appraiser now, let's take a look at it with perhaps the new countertops that would be typical of today's marketplace and the new types of cabinetry. And
Correct.
You have some flexibility there, but that appraiser now has a little bit higher burden to be able to do that. What's been your experience in working with appraisers on getting these properties appraised out at the new suggested price?
So typically, especially this past year with values moving up as nicely as they did, we really didn't see any problems with the 203K appraisals coming out. Of course, it becomes really as extensive as somebody wants to get on their renovation. So the more that a buyer adds to his wants list, the higher that renovation cost is going to be, the tougher the appraisal is going to be. So typically we've seen that if a HUD consultant keeps it to what the necessary requirements are, the minimums, maybe mechanicals, and of course a kitchen and a bathroom, and if the finishes are kind of middle of the road in terms of where finishes are, the appraiser typically has an easier time in terms of getting the final value to come in to where everything would be fine. So in that case, when we do have an appraisal that doesn't come in as high, then they have to go back and they have to start removing some items from the renovation report, the HUD consultant report, to try and bring that down. And that gets a little tricky because the items that they remove should be items that are not going to affect the appraised value as much. So maybe little incidentals and little finishes that will reduce the price, but maybe not so much reduce the appraised value.
Right, but for the most part, you've had very positive experiences in working with those programs.
We have. It's very good. And usually the limited 203K where it's $35,000 or less is a lot easier because those, that money's used for some main components. Let's say if doing a kitchen, there's an immediate benefit to that in terms of the appraised value. So yeah, so typically we haven't had many problems, in the limited 203K is usually one that's got even less concerns and less obstacles.
That's good to hear. I know personally I've represented several buyers of late that have been able to be successfully using the 203K program. There is an education part of the process, and it's typically a seller education process or a listing agent education process as to where we're at on those. One of the challenges, I believe, too, that we've seen in the marketplace is this is an ideal program for a property that would be a complete turnaround type property. However, with the cash marketplace being relatively strong, there's been a lot of the flippers, which we use the term in the industry, a lot of renovators that have come into the marketplace, done a lot of renovations in the last 3 to 7 years and have been very successful, and there is a plentiful amount of cash that's in the marketplace. So oftentimes the individuals that are trying to buy with that 203K program, it can be somewhat frustrating because oftentimes they are competing against cash buyers, and then ultimately the program itself, while sound, can have a few pitfalls. So again, that's probably why having a good real estate professional to assist you might give you a better shot at trying to be able to get that type of an offer accepted.
And what I've been hearing from agents like yourself and a lot of other agents is that now that prices have come up and it's becoming a little bit more difficult for flippers to come in and buy and have enough of a profit margin in there to resell it, that there's a little bit better of a market for people that want to come in, buy it as their owner occupied, use the 203K program, because they're not worried about having to flip it for a profit. So as those prices have come up, I think now the people that want to come into the marketplace right now and buy something that's dated, use the 203K program, is getting a little bit easier. They're not competing with the cash. They're not competing with the cash contractors that are trying to flip the property, just because values have come up, and that's kind of squeezed the profit margins for some of these flippers coming into the marketplace and having to pay top dollar for these dated properties.
Right, right. Probably kind of finalizing and taking a look at overall marketplace. One of the other things that we typically see now in the market is the final product itself, which is the renovated home, and then that comes on, and the sticker price on those homes obviously is a fairly significant pricing, because it's based on that renovator's acquisition price. It's also based on their renovation costs plus their profit into it. So in that scenario, from the economic side, individuals buying that home may get what they're looking for, and there seems to be a tendency in the marketplace to see it, like it, love it, and want to try to buy it, but it's not always that easy. And any final thoughts on putting loans together for those flip properties? Have you seen anything that you'd like to share with us on those?
Representing buyers that want to buy
where they've actually
products.
gone under contract and then they've purchased homes that were completely renovated. I'm sure you see that in the marketplace.
Oh,
often
absolutely.
Too. Yeah.
Absolutely. Typically what we've seen in those, especially this past year, is that the properties that were all done and completely updated, there were multiple bids, and I've had many buyers that actually lost out on a lot of those properties. So typically what we do is we try and give a buyer at that point the highest pre-approval amount that we can give them, just so that they can go to the seller or the listing agent when they're putting in their offer to show that they're approved for even more, to kind of take out any doubt from a listing agent standpoint or the seller standpoint that they could be approved for the mortgage. So typically if it's a completely renovated property and there's a lot of demand, a lot of activity on it, we're typically giving these people as high of a pre-approval as we can, as they can be approved for, even if it's $50,000 or $100,000 more, just to make them look better in terms of the listing agent and the seller when they're accepting or when they're negotiating their bid.
Okay, that's good to hear, and of course we always anticipate an exciting year as we finish up in December of 2018. Personally, our office, we're seeing a little revitalization in the marketplace in December, although we're only today, the 10th of December. The last few months have been somewhat lighter in sales, and that is somewhat of a counterbalance to the hyper activity that we had in the spring. And one of the things I always think about is there's only so many homes potentially that are going to be sold in any given year. It doesn't matter if the deals are great. There's only so many buyers. And I believe personally that the market has been kind of catching its breath over the last 3 or 4 months. But now all of a sudden we're in December, and I think we're seeing very strong activity considering that it is December and holiday season. And that bodes well for 2019. Also, the interest rate factor, which we discussed earlier in our discussions today. So I would be remiss if I didn't mention that we're working currently within our office at Weichert Realtors All Pro to help Ron and his cause that he works with at this time of the year in holiday season. So Ron, what other than being an active participant in the mortgage business from the charitable side, what are you working on right now on that?
So currently we are doing our 8th annual Ricchio Family Toy Drive that benefits Lurie's Children's Hospital and Ronald McDonald's Hospital out of Loyola, their children's hospital there. And we started this back officially 8 years ago because my son was treated at Lurie's back in 2007 and 2008. And it's a great, great cause. We spent time during the holiday season at the hospital, and just to see some of these children when they receive a toy, the look on their face, it takes their mind off of things that they're going through at that point in time in the hospital. So we're collecting new unwrapped toys for children and teens of all ages. You can even give gift cards. They typically do not like any stuffed animals for sanitary reasons. And we're collecting them all the way through here through Sunday. I believe Sunday's December 16th. Yeah, I believe Sunday's December 16th. So we're collecting new used toys. I'm sorry, no used toys, new toys, unwrapped, and we are collecting them here at Weichert offices as well as my own office at 5521 North Cumberland Avenue in Chicago, and it's Suite 1108.
That's great. And our Weichert offices, just for anyone that's listening, if you haven't seen our large yellow sign that says Weichert Realtors All Pro out there, we have offices located on Grand Avenue in Chicago near Grand and Harlem, Belmont Avenue in Elmwood Park, an office on the north side of the city down at Irving and Lincoln, and finally a new office that we've just opened up this year in Park Ridge. So feel free to contact us. If you have any donation, contact Ron. Ron, you want to provide your phone number again, just in case someone needs to get in touch with you directly on that?
Absolutely. My number is 773-557-1000, 773-557-1000. I'm at extension 11.
And my name again is George Ristau, the host today for Hour 91, our podcast. And if you needed to reach me, reaching out to our offices for any kind of drop-off for Ron's toy drive for Lurie and for Loyola, you can contact me anytime at my cell phone, 708-205-3868, and we'll give you exact addresses, and hopefully you can also participate and join us in the holiday spirit. So again, thanks, Ron, for attending today, and thanks especially to Gino Pronos, our technical guy behind the scenes, who puts all of these great podcasts together for all of you. Thanks again.
Thank you, George. Thank you, Gino.